just to indicate a loss. So remember, I'm gonna call it a foreign exchange loss, but I'm gonna specify OCI. Okay, that's the difference here, right? And then my credit is to my investment in forward contract for that 10,000. Okay. Now, because I'm putting it to OCI, this is not this in a fair value hedge we would offset, but here we're just putting it to OCI, so there is no net income effect, right? So we don't need to offset. So we don't do anything here. Alrighty, then 131 rolls around, right? So what's happening on 131? We're actually going to buy the inventory for the euros, okay? So remember, the first thing we're going to do is update the forward contract in value. So it's now at 0.98 because it's the day of, right? So 0.98, this brings us to 490. So if I'd waited till today to purchase that, purchase those euros, I'd be paying 490. So I have another $5,000 detriment because I have to pay 505, right, for stuff that's worth 490. So that's just what happens, right? So I have a $5,000 loss. So the first thing I'm going to do is update that. So my FX loss to OCI is 5,000. And I'm going to credit my investment in forward contract for 5,000. Right, and notice the difference between these two is 15,000. It's on the credit side, so it's a liability at this point. And notice that the balance in that account is going to be 15,000 credit. Okay. All right, now we are going to go ahead and purchase. We're going to close out this contract. Okay. So how much cash do I actually have to pay? How much US dollars? Well, I agreed to pay 505. So I'm going to credit US dollars for cash for 505. Right? And what am I getting in exchange? Well, I'm getting euros that I know are only worth 490. So I'm going to debit my investment in euros for 490. Right? And I've already recorded that loss, right, in OCI, but now I have to close out the investment account. So I'm going to debit my investment in forward contract for the 15. Okay, so now I'm going to come over here. Is there anything going on with the inventory? So yes, this is where I'm actually purchasing the inventory. So I'm paying $490 for it, right? So I'm debiting inventory for $490, and I'm going to credit my investment in euros. That's how much I have, right, over here. I'm going to pay that out. Okay, so now remember, this OCI loss is still sitting here. It doesn't get moved out of OCI until I sell that inventory, okay? So on 2/1/24, I'm going to sell all the merchandise to a third party for $600,000. Okay. So this is journal entry number 4. I'm going to come over here and I'm going to debit cash for $600,000. Credit revenue. My cost of goods sold, right, is going to reflect what I paid for the inventory, that $490. And I credit inventory, just like my regular sales inventory journal entry, right? 4-parter. All right, then I'm going to come over here and I'm going to clear out that OCI. So I'm going to credit FX loss, OCI 15. And what do you think I'm going to debit? Right, I'm going to debit the expense associated with that asset. So I'm going to debit cost of goods sold for 15. Okay. So just remember, if you have a firm commitment, that's a fair value hedge. That's where you exactly offset the gain or loss and you use the firm commitment account. If you just have a forecasted transaction, you're just going to keep track of that hedge, record it to OCI, and then get rid of the OCI when you get rid of the asset or if you depreciate the asset. Okay. Then case E is we could have a forward contract to speculate in foreign currencies. So this is if it doesn't qualify as a hedge and you're just using it to speculate, then you're just going to record any gains and losses right to net income, right? If you're willing to take the risk, it's going to show up in your net income, okay? All right. And then, let's see here. As I mentioned before, ASC 815 specifies certain minimal disclosures for derivative instruments. You can read more about that if you want. I'm not going to test you on that. I feel like it's such a specialized thing that it doesn't make sense to test you on the individual components of that. But let's talk about the concept quiz number 4. So on December 1, 2024, we plan to purchase a piece of equipment in Switzerland during January of 25. The transaction's probable. The transaction's to be denominated in euros. On 1/1/24, we enter into a forward contract to buy 100,000 francs. What kind of hedge is that? Right. Hopefully you said cash flow because it just says plans, right? Okay. Then the second one is we contract to sell equipment on December 1st. On that same day, we enter into a forward contract to sell pesos. So because we're contracted to sell equipment, but we haven't yet sold contracted, that's a fair value hedge. Okay. And then this last one, there's a bit of a typo here. Just scratch this off. In this one, we import some oil from an oil company. We agree to pay 50 million bolivars. To ensure that the dollar outlay for the purchase will not fluctuate, we enter into a forward contract to buy 50,000 bolivars at the forward rate. Is this hedge accounting? No, right? This is not hedge accounting. These two are hedge accounting because they give you special rules to be able to either offset or move the gains and losses to OCI. This is just regular accounting, right? Regular accounting where we hedge. And as we showed, like an effective hedge helps you offset the gains or losses. We don't need special accounting to help us do that. Okay. All right, and then the last page is just kind of a summary, in case you need just a little bit of reference. Okay, so that is it for the Chapter 8 lecture. I will post the homework, and then again, please reach out. I was going to have us do some in-class problems, and so I think I might still post some in-class problems, or I'll post some problems and I'll work through them. So yeah, be on the lookout for that. Thanks, guys. Have a great spring break.